Venture capital firm Andreessen Horowitz, A16Z, has expressed concerns over the draft crypto regulation bill proposed by the U.S. Senate Banking Committee, warning that the current framework could open dangerous loopholes and undermine investor protections. The firm urges lawmakers to revise the bill, specifically the concept of ancillary assets, which refers to tokens sold with an investment contract that give buyers no equity, dividend, or governance agency rights. Key concerns with the draft bill. Ancillary Asset Concept. A16Z believes the current approach to ancillary assets is problematic and incompatible with the Howey test, a long-standing legal benchmark for defining securities. The firm suggests adopting a digital commodity framework, which would provide greater certainty while preserving regulatory simplicity. Loopholes in securities law. The firm warns that applying securities law to primary transactions and commodity regulations for secondary transactions creates a loophole, allowing issuers to sell ancillary assets to insiders under exemptions and then resell in the public market without falling under securities regulations. Insider sales. A16Z recommends limiting insider sales and requiring projects to achieve decentralization by eliminating mechanisms of control. This would prevent insider enrichment at the expense of public investors and ensure the distinction between primary and secondary markets remains meaningful. Suggested solutions. Control-based decentralization framework. A16Z proposes adopting a control-based decentralization framework to evaluate the evolution of an ancillary assets risk profile. This approach would focus on whether any party retains unilateral authority over the blockchain system. Codifying the Howey test. The firm suggests codifying the principles underlying the Howey test for assets under a control-based decentralization framework, rather than abandoning it. Clarifying core technology functions. A16Z recommends clarifying that core technology functions necessary for decentralized blockchain systems, such as running consensus algorithms and executing smart contracts, do not constitute regulated financial activity under U.S. securities or commodities laws.